Hello and welcome to The Explainer. Today, we're diving into a really critical provision for any innovative business in India. We're talking about Section 45 of the proposed Income Tax Act, which is all about tax deductions for your spending on scientific research. So let's jump right in.
So let me start with a question for you. Is your company investing in R&D? If the answer is yes, then you need to ask yourself, are you really sure you're getting every last bit of tax benefit you're entitled to while still playing by the rules? That's exactly what we're here to figure out today.
Okay, so here's our game plan. We'll kick things off by decoding the new Section 45 to see what's changed from the old law. Then we'll break down the three main ways you can claim these deductions: for research you do in-house, for research you sponsor somewhere else, and for donations you make. And finally, we'll wrap everything up with some must-know compliance points and the key takeaways you'll want to remember.
All right, let's start with the basics. You see, the whole idea behind the proposed Income Tax Act is to clean things up, to make the tax code more streamlined and modern. And honestly, Section 45, by bringing all the R&D deduction rules under one roof, is a perfect example of this new, simpler approach.
Okay, so the big change here, the one you really need to get your head around, is that Section 45 is taking the place of the old, and let's be honest, often confusing Section 35. And look at these changes. No more juggling previous year and assessment year. It's all just one simple tax year now. Plus, those weighted deductions, the 1.5x benefits, they're gone. The goal here is pretty clear. Simplify, standardize, and make the whole system fairer for everyone.
And this right here is a really important simplification we need to talk about. Think about it. Before, we had to keep track of two different things: the previous year, when the money was earned, and the assessment year, when it was taxed. It could get a little messy. Now, the new act just combines them into one single tax year. It's simple, it lines up with the financial year, and it cuts down on a whole lot of potential confusion.
All right, let's get into the nitty-gritty. Pathway number 1, claiming deductions for your own in-house R&D. If your company has its own research facilities and is doing its own research, this is for you. It's all covered under Section 45, subsection 2.
So how does this actually work? Well, it's a very clear step-by-step process. First up, you file a Form 11. This is basically your application to the Department of Scientific and Industrial Research, or DSIR, to get an agreement in place. If everything checks out, the DSIR gives you the green light with an approval order, which is Form 14. But it doesn't stop there. Every year you have to get your R&D accounts audited and then file Form 13. And to close the loop, the DSIR sends its own report about your facility over to the tax department. That's Form 12.
Now let's zoom in on Form 14, because this one is absolutely crucial. This isn't just another piece of paper. Think of it as the golden ticket. It's the official approval from the DSIR that says, yes, your facility is recognized. And that's what makes you eligible for those deductions. So you've got to keep this document safe.
But listen, getting that approval in Form 14 is really just the start of the journey. The law is very clear. You have to stay compliant. And that means you absolutely must keep separate, audited books just for your R&D expenses. You've got to submit annual reports on your progress. And here's a big one. You can't just sell off assets you bought for R&D without getting permission first.
Okay, so that's in-house R&D. But what if your company doesn't have its own research facility? No problem. Pathway number 2 is all about sponsoring research. This is where you fund a research program at an approved place, like a national lab, a university, or an IIT, and still get the deduction.
And just like the in-house route, this one has its own clear form-based process. As the sponsor, you kick things off by filing Form 7. This basically outlines the research program you want to fund. The institution then approves it and gives you a Form 8. Once you make the payment, you'll get a receipt. That's Form 9, and you have to hold on to that. And lastly, the institution lets the tax department know about the approval using Form 10. See? A very clear trail.
Now, for all the tax professionals watching, pay close attention to this. This is a big one. This quote from the official guidance note basically says that getting that Form 8 approval is just step 1. It's necessary, but it's not a golden ticket. Whether you actually get the deduction or not will depend on if you've done everything else right when your assessment comes up. This is a classic sticking point, so be aware of it.
It's also super important to know what does not count as scientific research in the eyes of the law. Things like market research, your day-to-day quality control checks, or just routine data collection. None of that is eligible. The tax break is meant for real, genuine innovation in the extension of knowledge, not for your standard business operations.
All right, on to our third and final pathway. This one is for donations.
So, if your business wants to support the bigger picture of research in India by donating to an approved organization, this is how you get a tax deduction for it.
So who can you donate to and still get the deduction? Well, Section 45 is very specific. You can donate to an approved research association, a university or college for research purposes, or even an approved Indian company whose main goal is specifically scientific R&D.
One of the running themes in this new law is transparency and traceability, and Form 15 is a perfect example of that. Basically, any institution that receives a donation for research has to file Form 15. It's an annual statement listing all the donations they've received. What this does is create a perfect paper trail, letting the tax department easily match the donor's claim with the institution's record. Okay, so we've walked through all three pathways. Now it's time to bring it all together and talk about what this means for you in practice. How do you stay on the right side of the law?
Let's run through a quick compliance checklist. This applies no matter which pathway you take. First, keeping separate audited books for all your R&D stuff, that's not a suggestion, it's a must-do. Make sure you file every single form on time. And your paperwork, you need to be a librarian. Keep every approval order, every payment receipt. And don't forget that rule about assets. If you bought it for R&D, you can't just sell it without getting approval first.
Now let's talk about some common mistakes, the traps that people fall into. A big one is thinking that just because you have the approval order, the deduction is a done deal. As we saw, it's not. Another common slip-up is trying to claim for things that don't even qualify, like that market research we talked about. And probably the easiest mistake to make is just dropping the ball on your reporting duties after you get approved. If you don't submit those annual reports, you could lose the entire deduction.
All right, let's wrap this up with the key takeaways. First, Section 45 really does simplify and streamline things. You've got three clear options: in-house, sponsored, or donations. The key to success is really knowing the specific process for your path and, I can't say this enough, keeping meticulous records. And finally, the big theme here is transparency and traceability. The new system is designed to make everything clear and verifiable.
And that brings us to the end of our deep dive into Section 45. I really hope this breakdown has made things clearer and helps you navigate these new R&D tax incentives. Thank you for joining us. If you found this useful, please do like, subscribe, and share.
And just a quick reminder, this is an educational explainer. It's not professional advice. Tax laws are always changing, so please, before you take any action, make sure you talk to a professional advisor.